Okay, so number one. So once again, I will be giving you 5 questions. So here's just a little practice here for you. I want the question here is going to ask you to determine the account type, the category, and the normal balance. So, number one, checking. What kind of account type is checking?
Is it an asset?
It's an asset. Now, what kind of asset?
Current.
Current. And what kind of balance would it normally have?
Debit.
Debit. Good. Because it's an asset, right? We would increase our checking account, right, through sales, right? All right, and we would normally use a debit to reflect that, right? The definition of a normal balance is which side does the account increase on, okay? What about accounts payable?
Liability.
It definitely is a liability. Now, what kind of liability?
Recurrent.
Current. So typically, liability accounts payable are usually anything that's due within 30, 60, 90 days, or any short-term loans. Okay. And what kind of balance would it normally have?
A credit.
It would definitely have a credit balance. So once again, if this is confusing for you guys determining on the normal balance, use the accounting model. That will definitely help you. Okay. What about supplies expense? Oh wait, sorry, I skipped one.
It's
Inventory.
inventory. Inventory is an asset and is current.
Yes. And what kind of balance would it normally have?
Debit.
Debit, yes, right? Because you always increase assets with a debit. Okay. What about supplies expense?
Supplies is an asset.
Well, supplies in general is an asset, but this is supplies expense.
Expense.
The category is current.
Mm, not for this one.
Chapter 2, supplies. From the last time, we have the type is an asset, the category is current, and normal balance is a debit. So now you're saying it's not that?
Supplies is definitely a current asset, but this isn't supplies. This is supplies expense.
Supplies expense.
This is where we record using the supplies, where we get rid of the supplies.
Hmm.
It's an expense.
It's an expense.
Okay.
So in this case, right, we'll take a look in the example in the fictitious business where we buy office supplies, right? But when we buy office supplies, we're obtaining it, right? But at the end of the given period, we need to reflect that we used it. So this is supplies expense, okay? Keyword here is expense because oftentimes you're going to determine your expenses is that they at the end of every word or every account there's expense in there. So in this case, this is us determining that we're using the supplies. So this is an expense account. Now, what kind of expense account is this one?
Operating expense.
It's operating expense. Excellent. Okay, and what kind of balance would expenses usually have?
Debit.
Yes, right. On the accounting model, you always increase your expenses with a debit. Okay. What about accumulated depreciation? What about accumulated depreciation?
The depreciation.
Say that again, Nathan.
It's the just the depreciation, right?
This is accumulated depreciation. It's not depreciation expense because I believe one of these questions has depreciation expense in it. Yes.
What would be an example of accumulated depreciation?
So, for example, when we learned the whole depreciation method or depreciation, right? We would write it off as a depreciation expense. However, the accumulated depreciation, right? Because we can't write off on our fixed asset, right? Because you're not allowed to due to rules of GAAP because you have to record it as historical cost. This is a contra account. So then when you put it in there, at least you know how much the asset is worth in case you do either sell it out. So this is a contra account that allows you to let you determine what the book value of the asset is.
And that would influence the value of the business, correct?
Yes.
Then it's an equity.
No.
No?
That's an asset. So
It's an asset. Yes, because it's a contra asset account. Because in this case, I'm using accumulated depreciation to decrease my asset. Okay? Now, in this case, I'm not physically taking it right off of my fixed asset, but I am creating a contra account to reflect so I know what the book value of my fixed asset is. Because if I use my printer, right? I bought a printer for $150. If I use my printer, can I say that my printer's still worth $150? In reality.
No.
No, because you used it. But according to GAAP and um the rules of GAAP and how they say how a business is, they tell you it's worth $150 because that's what you purchased it. However, you need to create a contra account to reflect that you are using it because when you do sell it, you can't sell it for $150. You have to sell it for whatever the price should be because you used it. So in this case, this is a contra asset account. So if since we know it's an asset, right? Now, what kind of asset does this reflect?
fixed asset.
A what kind of asset?
Fixed.
Fixed assets, right? Because accumulated depreciation is directly correlated with fixed assets. Okay. So now, if it's a contra asset account, what is it? What is its normal balance?
I have I have a question.
Go for it.
Um, this can you go to the top of this form? Oh, so this is in chapter two, because the chapter two one that I have is we didn't go over this. We went over some another form that looks like it, but it's different.
No, it's not. The only
So
difference I have here, the only difference I have here is that my normal balance, I kind of give you the options. Is it debit or credit? That's the only difference.
No, I think she's talking about we haven't go over this on chapter 2 because we haven't learned anything on this chapter.
yeah, we went over this
Depreciation.
526, and we didn't. This is not the one that we went over. The one that you're doing right now.
Are you talking about the account accumulated depreciation?
Yeah,
Chapter two,
she's talking
extra
about
five.
that.
I'm sorry. What? Sorry, Nathan, and you guys
Go
were
ahead,
talking.
Nathan.
What was it?
Go ahead, Nathan. He's explaining better.
No, what I understand Kim was talking about. We didn't discuss about depreciation expense in this chapter. What she's looking at it is but this chapter came in later, so that's what
Yes.
we have
Yes.
right now.
Yes. Okay, the accounts are not from chapter 2. The concept of determining what account types are, what the categories, and what normal balance is are chapter 2. But the account types, this is things that we learned throughout the rest of the class. So chapter 7 all the way up to chapter 11, we learned about accumulated depreciation. If you go back to chapter 11 PowerPoint, I even have it right there that it is a contra asset account. Depreciation expense is an adjustment entry, and of course, it's an expense, right? So, all the account types are things that we learned throughout the rest of the class. It's just the account type, determining the account type, determining the category, and determining the normal balance is concepts from chapter 2. Is that more clear? Because in chapter 2, we learned about the asset types, right? What are the 5 asset types? In chapter 2, we learned about what the categories are. We also learned about the normal balance in chapter 2. So that's what I mean about this section is testing you once again. Do you know what your asset types are, what the categories are, and what the normal balance are? And this right here, I'm not going to test you things that you learned from the very basics of every class. This is going to be gradual learning because you need to know and you need to be able to determine each account because as we progress in class, there's more things that you need to know. Is
And
that
you're saying that you taught this in chapter 11?
the entire chapter 11 is all about depreciation. This is the account that we use to record depreciation. Yes, this was in chapter 11. Do we need a quick review of all the chapters before we do the study guide?
No, continue on, please.
Okay. So, chapter 11, we talked about accumulated depreciation because that's how we recorded unaccumulated depreciation. Right? When we compute depreciation, how do we record it in our books to reflect it? Accumulated depreciation is one of those accounts that we use. Okay? So in this case, accumulated depreciation is a contra asset account because it goes against the fixed asset. So we determine it's an account, asset account, and we determine that it's a fixed asset. Now the question is, what kind of normal balance would accumulated depreciation normally have?
Is it a debit?
Okay, so what is
It's a contra account, so it will be a credit.
you think there? Good.
Isn't it
Excellent.
offsetting against the assets?
Go ahead. Repeat that question again, Nathan.
Isn't it offsetting the assets? So
It's offsetting the asset, correct. So it is going to be a credit. Yes, because in this case, you're reducing the value of your fixed asset because it's a contra account. All right. What about bad debt expense? Bad debt expense is what we learned in chapter 10. What kind of account or what kind of account type would a bad debt expense be?
It's an expense and it's a debit.
Good. It's an expense because keyword right here,
It's
expense.
expense.
This is our means to write off bad debt. Okay, so this is how we get rid of it in our company. Now, if it's an expense, what kind of expense is it?
current.
Not current, okay? There are two categories under expenses. Right? There are two categories under expenses.
Can you scroll up just a little so I can see the options? Well, goodness.
Yes. Okay, so chapter 2, you pull up that review sheet, it will tell you what are the two categories under expenses. Okay? One is directly correlated to inventory, and the other one is just for the general business. Okay? So bad debt expense is considered an adjustment entry that is necessary to do because in case we need to understand how to write off something, right? Write off our debt that we are uncollectible. So is that directly correlated to inventory? No.
Isn't it correlated to accounts receivable?
It's correlated to accounts receivable, but accounts receivable, accounts receivable is to revenues, right? Because it's money that you earned, right? So in this case, all right, okay, review. What are the two categories under expenses?
On the review sheets, you actually have 3 categories.
Right, but I don't teach you the third one.
So it's cost of goods sold and operating expense.
Okay, so cost of goods sold is directly correlated to inventory, right? When you sell a product or, sell your inventory, you write it off using cost of goods sold. And then operating expenses is when you're just doing regular business, regular operating stuff to run your business. So out of the two categories that you just listed there, Erica,
Cost of goods sold.
Okay, so bad debt expense is not directly correlated to inventory, right? It's directly correlated to accounts receivable, which is for your revenues. No, there's no linkage to inventory here. Because if I sell a product, what does that have to do with me collecting bad debt? I have cash people too who can buy a product from me. And when I use cost of goods sold, that's me calculating how much I need to get rid of my inventory. So is bad debt anyway in correlation of inventory? Now, what about operations, right? In order to run my business, don't I need money? And if I'm not receiving the money,
You can run your business.
yes, you can't run your business. So in this case, how would you determine this one again? What's bad debt expense?
Operating expense.
Operating expense. Okay, good. Now, you mentioned it is a debit, and that's correct. Okay. All right. What? Okay, so I added an extra account that is the same thing, so you can ignore that one. We all know that inventory, right? It's the same thing as up here. Um, so this one's supposed to be something different, but it's okay. I'm just gonna skip it. Okay. What about unearned revenue? Now here's the key word. It's unearned. What is unearned revenue?
The revenue.
It's not a revenue. It's not yet a revenue.
Is it income?
Income and revenues are the same thing, so not this one, okay? In this case, unearned revenue, right? In context, it means when when a customer pays you in advance for services. They give you an advance payment. It's not considered a revenue or income because you haven't earned it yet.
So it's a liability because you actually owe a service for the money that you got.
Absolutely correct. Okay. Yes, that is correct. When a customer gives you money, you are obligated to have to provide the service. So in this case, you haven't done it yet because they gave you money in advance for the service. So it is a liability because you owe the service to them. Now, is it current or is it long term?
Would it be current?
It would most 100% be current because I don't know any long-term projects that people give you money in advance that take over a year to complete. Now you can do was it those sections that you can complete, but if someone paid you for services a year in advance, I mean, that's a long time, you know? So in this case, it is going to be current. Most likely the service will be provided within a year. Okay? And if it's a liability, what kind of normal balance would it be?
Credit.
It would definitely be a credit balance. Okay? What about accounts receivable?
Asset, current, and debit.
Good. It accounts receivable, once again, it's the money that your customer owes you. So in this case, it's considered cash that we have. Okay. What about furniture?
It's an asset that's fixed
Yes.
with a debit balance.
Correct. Right? We talked about furniture. It's a fixed asset. It has a life of its own. Good. And it's one of the three things, right? Property, plant, equipment. It's part of the plant because furniture is anything that's inside the building. All right. What about owner's withdrawal?
Equity.
It is equity. Okay, in this case, it's owner's equity. And what kind of category would this have?
No category.
No categories. Excellent. And what kind of balance would this normally have?
Credit.
Credit? No. So in this case, what does an owner's withdrawal do? Does it increase equity or does it decrease equity?
Decrease, right?
It decreases it because owner's withdrawal, you're taking money away from the company. So would you increase it or would you decrease it using a debit or a credit?
Because they did everything.
You decrease it with a debit, correct. Okay. What about sales?
It's a revenue account.
It is a revenue or income, whichever one you want to refer it to. Ooh. Revenue, income. Okay. Now, what kind of category would sales fall into?
Just say
S, is that sales?
Correct. It'd be sales. So just
And
be
the normal
regular.
balance would be a credit.
Yes. All right. What about cost of goods sold? So we actually got to take a look at this front hand. Cost of goods sold.
EXP.
Okay.
Oh,
It's
expense.
mm-hmm.
The category is cost of goods sold, and the normal balance is a debit.
Good. Last two here. What about depreciation expense?
Depreciation. See that one.
Depreciation expense.
It's an expense.
It's an expense. Right? Hence the word at the very end, expense. Good. Now, what kind of expense would a depreciation expense have?
Is it the same as accumulated depreciation? Also fixed.
Okay.
This is a current period, right?
So, once again, what are the categories of expenses?
current or long term.
No. There's three categories under expenses, but I only taught you two.
Cost of goods sold and operating expenses.
Yes. So out of those two,
Operating expense.
it would definitely be an operating expense because this is correlated to fixed asset. Does fixed asset have
Right.
anything to do with inventory?
No.
No. So this is 100% an operating expense. Okay. Now, what kind of balance would it normally have?
Debit.
Yes. Good. Last but not least is going to be the allowance for doubtful accounts. Okay. Where do we see the allowance for doubtful accounts?
That is a contra account, right?
Contra account. Excellent. What is it a contra account to?
Accounts receivable.
Accounts receivable. Excellent. So therefore, how are you going to determine what type is allowance for doubtful accounts?
It'd be a debit.
It would be a debit. No, not for this one because it's a contra account, right?
So let me see. I don't know. On that one.
Okay. If you know it's a contra account to accounts receivable, what is accounts receivable?
That would be a credit. I'm sorry, a debit, because a debit is a credit.
Okay,
So accounts receivable is a debit, right?
so then if if the allowance for doubtful accounts is a contra account to accounts receivable, what's its normal balance then? If accounts receivable is a debit and a contra account decreases the accounts receivable, what kind of balance would the allowance for doubtful accounts have?
Still an asset, isn't it?
It's an asset, 100%. Yes, because it is a contra asset account, right? It's going to be categorized there because it's decreasing the account receivable. So for sure, 100% it's an asset.
It's also decrease the amount of an asset, right?
Correct.
So the category is a C.
Current. Good.
Is
Because
current.
yeah, so accounts receivable and the allowance for doubtful accounts are more or less the same account. Except one is you're increasing it with a debit, where the other one is the opposite. Because in this case, right, when we recognize bad debt during the year, what do? It's another placeholder for you to take the amount that the person owes you and put into the allowance for doubtful accounts because it's potential bad debt. Now, we also know that this is a potential bad debt that you can't collect. So at the end of the day, the allowance for doubtful accounts is still going to be credited because it's decreasing the accounts receivable.
Okay.
So in this case, it's a credit.
I
Okay?
have a question about the owner's withdrawal.
Okay, go for it.
On the last review, we actually agreed that the owner's withdrawal was a credit, not a debit. If you go back to the review for the first test, we have it as a credit.
The review sheet or the...
No, the test review for...
All right, so now going back to this. So now this is, so once again, a lot of these things that we see here, or some of them for the account names, are concepts that we've learned in chapter, chapter 9, 10, and 11, right? We learned about depreciation expense. We learned about what happens when we do that. We learned about allowance for doubtful accounts. So once again, these accounts are things that we taught along the way in the newer chapters, right? But the concept and idea of determining what kind of account it is, what category it belongs to, what kind of normal balance is going to be something that we should have picked up along the way as well. I've mentioned before that it is a contra asset account, because it's a contra account to accounts receivable. So if this is going to decrease accounts receivable, more or less it's going to be the same exact account type and account category. The only difference is here is that it flows in the opposite direction. Okay? So once again, please use this study guide to help you out for this exam in case you get stuck on that question where you're confused on a contra account. Okay, especially because these concepts we've learned in chapters 10, 11, all the newer chapters. We dealt with this concept, so it's not something that's completely new. It's things that we've practiced before. Okay, all right, so moving on. All right. Now we're going to dive right into chapter 4 here. So chapter 4, under the rules of GAAP. Which rule states that when you establish a business, okay, you need to keep your personal and your business transactions separate.
Monetary.
No. Because in this case, I'm not telling you how to record your transactions. Business or economic entity. Yes, because this is the definition of this one is keep your personal assets separate from your business assets. Keep your business transactions separate from your personal transactions. Okay, that's the definition of business or economic entity. Okay. Monetary tells you how you should record it. Okay, in terms of dollar value, in terms of a total cost instead of quantity. Okay. All right. Number 5, okay? If I purchase a machine for $500, okay? In my books, must be recorded as $500, okay? Even if I plan to sell it for $700. Which gap rule states this?
I'll say C.
Historical cost, excellent.
Yeah.
Historical cost always tells you in your books you're always going to record it at the original price that you purchased the item for, right? You cannot recognize a gain or a loss until you get rid of the asset. Okay, so that is correct. All right, and that's exactly what I'm going to be asking you. This is a very similar question right here, is that I'm going to have you guys apply the concepts to scenarios. So I could ask you, if I purchase something for $500 and I must record it at $500, what is an example of that? That's what I want to do. I want you to apply it. Excuse me. All right. Number 6, okay? All right, customer A purchases an item for $15.65 from your store on an account. Okay. A few days later, you receive a check for $15.65. You must properly record the sale and the payment. Okay. So which gap rule governs this?
Would that be matching principle?
100% matching principle, because in this case, I received a revenue, right? And because they gave me an exact check for $15.65, I am matching those two numbers together, right? That is correct. Matching, matching, matching. Number 7, cash basis is when
A.
A is correct, right? Because when we're doing on a cash basis, all we're thinking about is cash, cash, cash. Do we have cash? Is it in our hands? Did it leave our hands? That's the idea here, right? We only record revenues when cash is received, and then we only record expenses when cash is readily available to spend, right? Not when it's earned and not when it's incurred, right? Not when the day that it happened, okay? So excellent. A is correct. Number 8, which of the following is not a step in the accounting cycle?
I'm going to say D.
D, yes, making decisions based on financial statements. No, that is not a step in the accounting cycle, okay? This is for profit managers, whatever they need to use the financial statements for. So this is not even part of your job. Okay. All right. Now we're moving on to chapter 5, right? So this is where we're dealing with periodic inventory, okay? Or inventory in general, okay? So what are the tracking methods for inventory?
A.
A, periodic and perpetual. Good. Okay. Number 10. Okay, what are the costing methods used in inventory?
All.
All the above, yes, okay? Once again, we got to take a look at every single one. They exist, okay? Except for specific ID. We did not teach you that, but it does exist. Okay? Number 11, okay? When delivery charges are made on COD, what does that mean?
C.
Cash on delivery, good. Not code on demand, not currently order delivered, etc., etc. Okay? It is cash on delivery. Okay, that means once the package arrives, you must pay the service. Okay? Number 12, okay? What is the definition of periodic and perpetual?
Is it A?
A. Periodic means once in a while and perpetual means constantly. Yes, that is correct, right? Let's take a look at B. Periodic means constantly and perpetual means once in a while, which is not true. Periodic means at the end of at the end, okay? And perpetual means at the beginning. No, that's no. Okay, so A is correct. True or false? Okay, at the end of at the end of the period, okay, under periodic inventory, a a conversion entry is required, or in this case, a conversion entry is needed. Is that true or false? Under periodic inventory, a conversion entry is needed.
A.
A, yes, that's 100% true, okay? If you guys remember chapter 7 and chapter 8, once we reach the end of the period, do we need to have a conversion entry? No, because the inventory items are already in inventory, right? We didn't treat them as expenses in the very beginning. We treat them as they were inventory, so you can't convert inventory into inventory. It doesn't make sense. So for periodic inventory, yes, because you're converting an expense to inventory. Okay. So here we are under this. So let me see, what number are we on? We are on 14 and 15. So here you go. Use this table or information below to answer the next two questions. So once again, here's a little scenario of inventory. Okay, and here's a key thing that you need to know. Your inventory and your tracking and your costing methods is going to be periodic LIFO. Okay. So here I just have a little small table for us to go ahead and do this. So number 1, right? On June 1st, you purchased a total of 100 toys that cost $1 each, with the freight costing $25. So once again, it is June 1st, right? How many items did we buy? 100 at $1 each, okay? With the freight costing you $25. So, what is my purchase price? Or
100.
100 plus my freight gives me a total of
125.
125, which in this case, because we're using LIFO, what's going to be my cost per item?
$1.25.
125. Good. All right, let's see what happened next. On June 10, you purchase another 200 toys costing $1.25 with the freight costing you $50. So in this case, June 10, 200 items at $1.25 with the freight costing $50. What's my purchase price here? $250 plus 50. Total cost brings me this will bring you to 300. Okay. 250 plus 50, 300. So in this case,
Item is 150.
the cost per item is $1.50. Okay, good. Now let's see what happened next. Okay. On June 12th, you sold 200 toys at $5 each, no sales tax. Do I need to record this in my inventory worksheet?
No.
No, because we are using periodic inventory. We don't care about sales. So in this case, we can ignore this part. Okay. So then on June 15, we purchased 300 toys at $1.50 with the freight costing you $75. Okay. June 15, 300 at $1.50, freight costing you $75. So here, what is my total, what's my purchase price?
$175. I'm sorry. The purchase. What are we at?
Purchase price.
450.
For what?
450.
450. Okay, plus 75.
525.
525, which then $1.75. Good. Okay, good. Then we have right here is on June 20th, you sold 250 units. We don't care about that. And then lastly, on June 30th, you have a total of 150 toys left on hand. So right here, I've already filled it in for you. So in this case, right, let's take a look in this context. Now that I reached the end of my period, what do I need to do? What do I need to do in order to solve for the rest of my inventory worksheet?
Total up your purchase expense, freight expense,
Good.
total cost.
Good. So here, what's my total quantity?
600.
600. What's my total purchase price?
$800.
800. What's my total freight?
150.
150. So then what is my total cost going to be?
950.
950. So that's your total goods available. Okay. If I had 600 to begin with and I have 150 left, how many items did I sell?
450.
450. Okay. So now let's go ahead and use the concepts to solve for what the total value of my cost of goods sold is. So in this case, we're doing LIFO. Okay. So in this case, right, if I'm going for LIFO, which batch am I going to take out from first? the 300, right? If the 300 is going to cost me $1.75 each, my total here is going to be $5.25. Okay. Now, what about, okay, so now I got rid of my last batch here for the whole 300. How much more do I need to sell?
150.
You need to sell 150. So which batch am I going to be taking out from?
The middle one.
The middle one, which is which cost me $1.50 each. So in this case, we need to calculate this, right? What is 150 times $1.50?
225.
225. Okay. So therefore, here we have a total quantity of 450 at a total cost of
750.
750. So that goes here, 750. So then if I have 750 as my total cost of goods sold, what is my ending inventory?
200.
200, right? If my total cost is 950, subtract 750, my ending balance should be 200, right? If you solved it for the other way where you're calculating everything, that's also a valid way of doing that as well. Okay. So questions here is going to be exactly like what we had on the exam. What is the total cost of your ending inventory on hand?
200.
Yes, B, 200. Okay. Then question number 15 says, what is the total cost of your cost of goods sold?
750.
750. Good. All right. Any questions there for FIFO? I mean LIFO. Okay, so let me go ahead and fast forward. Okay, so the next three are going to be are similar. So in this case, right, they're exactly the same. So to save you some time, I'm going to go ahead and copy the table from above here because it's the same thing except we are calculating it differently. Okay. So I'm going to copy this information in this table and I'm going to drop it here because everything's the same. June 1st, you purchase 100. June 10, you purchase 200. June 15, you purchase 300. Okay? All the same. Okay? Except this time, right? Your tracking and costing method is going to be periodic FIFO. This time, we're looking at it using the other way, which is FIFO. So in this context, right, if I sold 450, right, so let's go ahead and see which batch am I going to be taking out from first.
All the 100.
The first one, yes, because we're doing first in, first out, we're going to take the first batch of our inventory, which is the 100 that we purchased on June 1st, which is for a total cost of $125. Okay. What about, so now, what's the next batch we're going to be taking out from?
200 at $1.50.
200. Now, are we going to take all of it or some of it?
All of it.
All of it, right? Because that's only going to give us a total of 300. So now, that whole entire amount there is $300. Okay. So then now, how much do we need to take out left in this case? How much more do we need to take out from our third batch?
150.
150, all right? Now in this case, since we're taking only some of it, what's 150 times $1.75?
260, 250.
262.50. Okay. So once again, we reach a total quantity of 450. Now, what's my total cost going to be?
687.50.
687.50. And I'm going to pop that in right here, 687.50. So then, what is going to be my ending balance? 262.50. All right. Right? We take our 950, we subtract the 68750 to get 262.50, right? Because that's how we learned. All right, so in this case, question number 16 says, what is the total cost of your ending inventory? In this case, 262.50. Okay. Next question says, what is the total cost of goods sold? C. 687.50. Okay. And that's how we do FIFO. Okay. Last one that we have here is going to be weighted average. So once again, all this information is the same. Only difference is how we are calculating it. So in this case, I'm going to do it again. I'm going to come up here because the information is going to be the same, except one key component here. I guess I'm going to do all of it. Right? One key component here is we need to calculate what? What do we need to calculate? If we're doing weighted average, what's the most important thing that you need to do?
Cost per item.
The average cost per item. So in this case, what should be my average cost per item?
I got 1.583333.
Okay. Good. You're going to take your total your total cost of $950, and you're going to divide it by your total quantity of 600 to get your average cost. So in this case, my average cost per item is $1.583333. Now, here, if I sold 450 units, my only equation I have to do is whatever 450 times by $1.58333, which should give me a total cost of 712.50. Okay? And if I solve this as 712.50, then what should be my ending balance? $237.50. All right, we're going to take my total cost of goods available of $950, subtract out my $712.50 to get a grand total of $237.50 as my ending balance. Okay? Or vice versa, you could have just taken the 150 times by the 1.5833 and got the same answer. Okay? So the question is, what is the total cost of your ending inventory? $237.50. Okay. And then once again, what is the total cost of goods sold?
D.
Okay. All right. Any questions in regards to how we calculate each and every periodic inventory, right? We look at an example of LIFO, FIFO, and we also got to take a look at weighted average. So that means on the test, I could test you on one of those three. Okay, so make sure that you understand how to do it. Okay, whether if I ask you LIFO, FIFO, or weighted average, you need to be able to do it. Okay. Any questions? No? Okay. So question number 20 is going to be linked to this example right here. So I believe I wrote to answer the next three questions. Yes. So in this case, how am I going to do a conversion entry for this example right here? Okay. What's my journal going to look like to convert my purchase expense into inventory?
Would you debit inventory and cost of goods sold?
Correct. You would debit your inventory and you would debit your cost of goods sold because in this case, cost of goods sold is directly correlated to my inventory. Cost of goods sold. Okay. And here I'm converting them back in, I'm converting them into inventory. Right? So what should be my credit accounts? What am I converting them from?
Your purchase expense and freight expense?
Your purchase expense and freight expense. Okay. So here, what was my ending inventory?
The 237.50.
237.50. Okay. What was my cost of goods sold?
712.50.
712.50. What was my total purchases? Purchase expense?
800.
800. Okay. And my total freight?
150.
150. Right? And if you add these columns up together, they equal each other. Okay, we got 950 on one side, 950 on the other. Okay, so once again, if you can imagine it this way, right? When we first purchase our inventory, we dumped them in our purchase expense and our freight expense. Now that we need to convert it, we're going to take our bucket and we're going to dump them in my inventory and my cost of goods sold. Okay, good. All right, any questions for chapter 5?
No.
Okay. So we have a little continuation here. Okay, it says that on June 17, okay, that you received 10 broken mugs, okay, and you request a full refund, okay, from the vendor. Okay, what accounts will be journalized for the return of your if you're using periodic inventory? Okay, if you if you received 10 broken mugs, so you're the purchaser, okay? If you bought something and you're requesting for a full refund, if you're using periodic inventory, which account will you be using? And how will you use it?
you're going to credit purchase returns and allowances.
Excellent, because you have to create a contra account to purchase expense. If we normally debit our purchase expense, then your only option is, in order to reduce the purchase expense, you need to have a credit for the account for purchase returns and allowances. Okay, so remember, that's the fine difference between periodic and perpetual. Okay, because you designated this as a purchase expense, you can't really undo expenses. You can only create contra accounts to reduce it. Okay, so good, excellent.
I have a question.
Go for it.
You say that we are a purchaser in this case. Who who is you? That's the problem I have here.
You're the one that's buying from the
Oh,
vendor.
okay.
Go ahead, Nathan.
So no, the question is which is confusing. You received 10 broken miles. So I am a seller or a buyer.
In this context, right, if you're requesting a refund from a vendor, what does that make you?
Okay. The next statement is clear. Okay.
Because you bought something from them. If you're requesting from a vendor, then in this standpoint, you're buying from a vendor. So, yeah, you're a customer in this case, yes. But in this case, we're looking at that I'm buying from a vendor. Okay. Question number 22. Okay, terms are 5%, 15, net 30. What does that mean?
Letter A.
You're going to take a 5% discount if you pay within 15 days. If not, you have to pay in full within 30 days. Good, right? It's not whether you pay now or pay later. Or you take the discount now versus later. Okay? So A is correct. Okay, number 25. Okay, what does net method mean? What does net method mean?
Take the discount immediately.
Take the discount out immediately. So, in a way to understand this, right? When you get paid by a company, you have your gross wages and then you have your net wages, right? Gross wages is where you've earned all the money that you've earned. Your net wages is going to be when you take out all the taxes that you have to pay to the government, and that's how much you're going to be taking home. It's going to be the net wages. So in this case, right, same concept here, right? When you do gross method, that's how much your total purchases is for. But if you're doing the net method, right, you're going to discount it and have the result after it's been discounted. So same idea here. Okay. All right, let's spend a couple more minutes on this little thing and then we'll go ahead and take a break. So question number 24. So now we're diving into chapter 6 territory. So chapter 6, question 24. A customer buys 10 shirts for $5 each. Sales tax is 8.25%. Okay. Total cost, total cash sales was for $54.12. Okay. The next day, the customer wants to return 5 of those shirts because they were the wrong size. Okay. So then the customer demands a full refund for these 5 shirts. What should the journal entry look like? Okay. Assume that assume that you are using periodic inventory. So if you sold something to a customer and they're demanding a full refund, okay, how are you going to journalize this?
I would say C.
C, sales returns and allowances, sales tax, and cash. That is correct, right? If you're gonna be charging your customers tax, right, you have to give the tax back. Okay, it can't be like D where you just give them all the money at once. No, because the $2.06 was not part of your earnings, right? That's money that you owe to the government, to the sales tax. So the answer here is going to be C, right? And in this case, right, we're not increasing our cash, we're decreasing our cash, right? We have to give the cash back to the customer. So excellent. Okay. So then question number 25 asks, okay, when there is a store-wide sales discount for 40%, you can only take a discount off of what items? Let me see. I think there's answer D in this one too. Okay. So what can you discount?
Merchandise.
You can only take a discount off of the merchandise selling price. That's correct, right? You can never discount sales tax, and you can never discount shipping or handling. So correct, A. Okay. Now here we have a lower cost of market example here. So let's take a look and then this will stop here. Okay. So lower cost of market. Okay, here's the given information, right? You have an original cost of $4.75 each. You have a replacement cost for $4.05. Your selling price is going to be $10.50. The cost to dispose the item is $1.33. And your amount of profit, you want to earn at least $3.55. Okay. So once again, let's practice. How do you solve for ceiling? How do you solve for the ceiling price?
The selling price minus the cost of disposal.
Good. Ceiling, I think there you go. Ceiling is going to be selling price of $10.50 minus the cost of disposal of $1.33. So what should you get here?
$9.17.
$9.17 for the ceiling price. Okay. What is going to be your floor?
Ceiling minus profit.
Ceiling of $9.17 minus the profit of $3.55. So what should you get here?
562.
562. Okay. All right. So now we need to compare 3 numbers. We're going to compare the ceiling. Okay. I guess I'll highlight it. The ceiling the floor, and what else? What's the third number you're going to compare?
Ceiling replacement and floor.
Ceiling replacement and floor. So, comparing these three numbers, which number is going to be in the middle?
Floor.
The floor of $5.62, right? Because in this case, right, 917 is obviously the highest. 405 is obviously the lowest. So therefore, in the middle between those two numbers is going to be the $5.62. So that is your market. So then, last question asks, and the question number 26 says, at which price is lower, cost or market? So is 562 lower than 475? So which one's lower?
The original cost.
The original cost of 475. So your answer is going to be C. Okay. All right, good. All right. So like I mentioned before, we're going to stop here and then we'll continue on after the break. Okay?